Hi folks, Chuck Gibson for Financial Perspectives with April 2018's Charts on the Move. The title of this month's video, well, it's a bit of false advertising on my part because our charts are definitely not on the move. Instead, as you'll see, most everything is not moving at all and is stuck in neutral. While it was not unexpected, April's market action did nothing to clear up the uncertainty we're seeing across most markets. We're stuck in a sideways trading range, and as mentioned last month, will likely not get resolution for a number of weeks, or more likely months. Let's take a look at some charts so you can see what I'm describing. The first chart is a daily look at the US total stock market. As you can see, it peaked in January from a short-term parabolic rise and has since chopped around sideways and formed a symmetrical triangle. These patterns have each successive high forming at a lower price than the prior, while each successive low is higher than the prior. Notice how each low is holding the green rising support line, and most importantly, the 200-day moving average. This is exactly what you want to see if you're bullish. A retest and hold above the 200. As you know by now, triangles provide no real investable edge on the expected direction of the breakout. Although, under most conditions, they are a continuation pattern, and as such, we need to expect its resolution to be higher. Either way, there should always be a plan in case that turns out to be wrong. My next chart, a daily look at the semiconductor index, is one I watch closely as it is the leading subsector in the market-leading technology sector. It looks slightly different than the total market index. It too is trapped in a sideways consolidation and at the bottom near this important level of support, but instead it is closed below its 200-day moving average. This was the first time this occurred since May of 2016, ending the longest streak in history. It still looks okay, but notice the bearish momentum divergence formed while in the process of forming this very ominous and obvious head and shoulders topping pattern. A hold below the 200-day moving average, followed by a confirmed strong move underneath the green horizontal support, warns of much lower prices, with a target down here at levels last seen a year ago. Looking a bit deeper at the semis, you can see in the next 10-year weekly chart the action that occurred when the market goes through extended consolidations. Notice how in the first consolidation in 2011, the RSI momentum divergence warned of a correction. Price then broke down below the uptrend line and eventually bottomed some 27% from peak to trough. The second consolidation in 2015 was also given a pre-warning with the development of RSI momentum divergence. That was soon followed by a break of the uptrend line, and once again, another 27% drawdown before a resumption of its trend higher. Fast forward to today, and we have the RSI momentum divergence warning, followed by a break of the uptrend line. Right now, we sit at 17% drawdown. Semiconductor bulls have to be wondering here whether this is it, or is there more to come? In my next chart of emerging market stocks, you can see they resemble most other stock indexes as they are trapped in a box, going nowhere. In fact, the index is in the exact same place it was 6 months ago. As of now, its price is above its rising trend line and 200-day moving average, and is not sporting RSI momentum divergence. Bulls want to see price hold above the green horizontal support line. A break below warns a much further downside. The next chart of India's Nifty 50 stock index shows a similar story, as price is stuck in this consolidation box, but is sporting a bit more relative strength, as it is well above both its uptrend line and 200-day moving average. On the downside, momentum divergence in the upper pane is present. Divergence is not a sell signal in and of itself, as it can and usually does go on for months and sometimes years before price eventually corrects when we're in a strong uptrend like we're in now. RSI momentum should be viewed as nothing more than one element in a weight of the evidence investment approach. If foreign stocks like the emerging markets in India are going to continue to do well, they will likely need some help from the US dollar by continuing its decline. In the next chart of the dollar, you can see it's been in free fall since topping at the end of 2016. But at the beginning of this year, it started consolidating sideways and has been trapped inside this rectangle until finally breaking out to the upside last week. Rectangles are my favorite pattern to invest from, once the direction's known. The longer the sideways action within the rectangle, the better, as that allows the market to come to equilibrium. As such, a move out of the rectangle usually leads to big, profitable moves in the direction of the break. Notice how, in this case, the consolidation occurred between the fourth and fifth touch of the falling wedge, and RSI momentum hinted strongly with bullish divergence that the breakout would likely be to the upside. The target for this move would be back near 93. A move to the prior October 2017 highs is not out of the question if this break turns out to be more than just a counter-trend bounce. If this breakout of the dollar to the upside is the real deal and has legs, we should expect to see weakness not only in foreign stocks, but all foreign priced assets, including bonds and commodities. My next chart of emerging market bonds is showing signs of real and continued weakness. Not only has it broken below its long-term uptrend line and below its falling 200-day moving average, but last week we saw price fall and close below this very important horizontal support line. Notice also this huge, very ominous rounded topping pattern. Memorize this because this is what tops look like. Emerging market bonds look lower, maybe a lot lower, as that pattern's target is down here at T1. In the same vein, a rising dollar could put pressure on gold, silver, and the mining stocks. My next chart of GDX, the Gold Miners Index, shows it trapped inside this rectangle for more than a year. With energy building, I do expect a powerful and swift move once it breaks out. This will likely create a real nice profit opportunity once it goes. But which way? A rising dollar would make me lean any break would be to the downside. But it is not impossible they could move in unison. It's just a lower probability. A good investor will not be tied to their beliefs or expectations, but instead react according to what the market gives you, because the market is always right. My next chart of the CRB Commodity Index shows how the index broke out from this long-term downtrend line in early 2016 and has been chopping around sideways for 2 years. One thing I learned that has stuck with me is to avoid investments, unless you're trading and have a shorter term time frame, of course, where the 200-day moving average is flat, as it typically represents dead money. There are likely much better opportunities elsewhere. Now that price sits above the 200-day moving average, which is starting to rise, a breakout of this horizontal resistance would present an attractive investment scenario. Much better than it has been during the past 2 years of sideways chop. This is and has been on my radar, as I believe inflation will be with us for at least a few years, and as such expect this to go higher, even with a rising dollar headwind. Turning our attention to bond yields, the 10-year yield touched the 3% mark, exactly as expected and warned by the charts. While I think yields will go higher, I expect we see a short to intermediate term decline in the near term. The current 3% level presents a resistance area the 10-year had trouble crossing in the past. Secondly, we have bearish RSI momentum divergence, warning of the rally is running out of steam. But also, the last week has formed 2 candles of a 3-candle abandoned baby reversal pattern. This is one of the most infrequent but significantly important candle patterns that develop warning of a price reversal. It still needs to confirm with a red down week this week, so it's too early to jump on board the reversal bandwagon. When there is a confluence of many different types of signals at one point in time and price like there is here, the case becomes much more compelling and as such should not be ignored. Since we're on the topic of bonds, I rarely look at muni bonds as I'm not a fan for many reasons. I thought I'd present their chart to see if they too, like other bonds, are falling prey to lower prices caused by rising rates. As you can see, since its top in mid-2016, price has gone on to make one lower high and one lower low, and currently sits below its falling 200-day moving average. Last week's candle was a possible reversal, so I expect a rally here in the short to intermediate term time frame. With eye on the longer term, if price rallies and fails to make a close above last year's high, I would expect it to eventually fall and retest this 2013 low. The last chart before I sign off is to circle back around and revisit the US Total Stock Market Index, except this time on a much longer time frame. This 10-year view captures the entire rise since the 2009 bottom. As you can see, the index rose strongly out from the bottom into 2011, where it consolidated, forming RSI momentum divergence, and eventually broke down below its long-term uptrend line. This consolidation lasted 40 weeks and provided investors a 20% drawdown. As we know, it eventually broke out to the upside and went on to make new highs. As we also know, that consolidation let the market come to equilibrium and allowed the eventual winner of that tug-of-war, the bulls, to build up energy to propel prices higher. And higher they went. Once again, in 2015, prices started another wide range consolidation, forming RSI momentum divergence and breaking the uptrend line. This one was slightly less painful for investors as the drawdown was only 15%. But while a less challenging drop, it took an additional 10 weeks, this time 50, before eventually it went on to make new highs out of the consolidation. Fast forward to January of this year, and once again, we're being challenged with another consolidation. While it feels bad, the drawdown has only reached 12% so far. And so far, we have not formed RSI momentum divergence. And so far, we have not broken the long-term uptrend line. But because we're only at 14 weeks in, we should not raise the all's clear flag. As mentioned before, I expect there to be many more months before we get final resolution, and as such, have to be open to the possibility of extending the decline beyond 12%. I'm hoping that doesn't occur. Apparently hope works if you want to be the president, but not so well when it comes to investing. Since we have no control over what the market does, all I can do is what I have done so far, and that is back off client risk exposure, waiting for the market's final decision out of this consolidation. A move higher, and we jump on board the risk train once more with a greater commitment. A decline much lower, and will likely trigger my long-term market sell signal, which will require me to move everyone to safer ground. Hey, stay tuned. With that, I'm going to call it a wrap. Until next month, as always, I appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with April 2018's Charts on the Move.